All right, sort of the clock is ticking towards the pre-open session. 2 minutes away. Rajesh Palvia is joining us now, Vice President, Technical and Derivative Research at Axis Securities. Rajesh, good to have you with us here. Thank you very much. You know, we were describing the market as, a boat without wind in its sails, momentumless really, at least for now. But what's data telling you on the F&O side, and what trades would you recommend?
Good morning, Prashant. So yeah, throughout the series, we have seen, out of the money call writers and put writers have made the money in this, especially in this series. Market remained in the only range of 300 point throughout the series. It's a sixth week where we are seeing, almost it's a very tight range for the market. Ahead of budget, these kind of activities is really surprising. But looking at the overall scenario, we believe that if at all Nifty manages to hold above 18,000 level, 18,050 level for this expiry, then possibly post expiry we are going to have a big move from here onwards. So we are bullish at this moment, and we expect that once we are able to cross above 18,150, then possibly this move can continue further higher towards 18,300 to 18,400. But possibly in today's session, it's going to be remain in a very range bound kind of situation in today's session also, as we are seeing that a lot of call writers are aggressive at 18,100, 150, even 200 zone. So these areas are likely to act as a resistance area. To play today's expiry trade, if we opens around 18,050, 18,020 level, then it's an opportunity to buy 18,050 call option, which was closed at around 94 rupees. So if it's comes near to 70 or 65 zone, one can buy 18,050 call option for today's expiry. Keep stop loss of 40. And on the upside, if it moves near to 110, one can book profits. For Bank Nifty, it's looking really interesting as we are trading near to 42,600 zone, which is very important for Bank Nifty. If we able to hold this 42,600, 700 zone in today's session, then one round of up move we can see in Bank Nifty towards 42,900 to 43,000. 43,000 is likely to act as a major hurdle for the day. So if at all we crosses those levels, then one round of short covering can be initiated in the Bank Nifty also, and then we can see further higher level from here onward. But as of now, looking at the setup, 43,000 is likely to act as a resistance, and 42,500 is the support for the Bank Nifty also. Stock specific, we believe that HDFC Limited can continue further. As we have seen a strong breakout on the weekly chart after consolidation of 7-8 week, and looking at the overall setup, the stock is moving towards its higher band of this series. So we believe that HDFC Limited can continue further, and the upside target would be 28.30, 28.40. One can buy with stop loss of 27.45. Another stock is from mid-cap IT space, that is Emphasis. In previous trading session, we have seen a strong buying action, and now stock is trading above 50-day, 100-day moving average. And looking at the breakout on the near-term chart, we believe that Emphasis can continue its upward momentum. And on the higher side, we are projecting target of 2180 to 2190. One can keep a stop loss of 2070 to buy Emphasis also.
All right, thanks a lot for that. By the way, in pre-opening rates, it settled flat, but with a bit of a negative bias, actually. Just keep an eye out on a couple of stocks. There is, of course, the auto names. Maruti Suzuki is up almost 0.7% after a very strong set of numbers yesterday. TVS Motor, interestingly, has opened in the red, but then the numbers were largely in line with estimates. The stock has also seen a fair bit of a rally, so let's see how that one plays out. A couple of other big names. The Adani Group is under a bit of pressure this morning. Adani Enterprises, Adani Ports, down about 1 to about 5%, so don't lose sight of that. And PVR is up about 1.5%. Pathan releases today, and if you go by the trade reports, expected to see a banging opening with about 40 crores on day one. But that's what analysts are saying. Any of you going to check it out, Pathan?
Yes, I'll be watching it tomorrow, second half.
And Nigel has promised to give a special preview on closing bell today, right? Pathan, Nigel?
I'm going to look forward to that.
And I've just been told about it, so maybe.
Is there some dance or something coming up?
My wife's a diehard fan, so I'll be accompanying her tomorrow.
Aren't we all? I mean, whatever the movie may be, good, bad, or ugly, you want to go there and watch Shah Rukh Khan on the big screen, right? Yeah. I mean, it's been a while since
come back after many years.
Yeah.
Absolutely.
Okay, so that's on PVR. Couple of other stocks, Pidilite, weak numbers, Macrotech developers as well. Nazara Tech could be in focus after its numbers too. In fact, Devin, just a quick thought on how to approach this entire consumption piece, because, you know, Pidilite, of course, is going to react to its numbers today. But largely, the narrative in consumption, whether it's Asian Paints, HUL, has been that growth is not recovered completely. What do you do here?
So Sonia, I think the commodity cycle has definitely, I think, worked against, I think, the companies, I think, particularly on the input cost side. And that is the reason for which I think the names like Asian Paint or even for that matter Pidilite and even some more, I think, are likely to have the impact on the margins in this particular quarter. But that does not take away the larger picture from these companies. I think they have relatively a very strong business model. And at the same time, I think the both for I think Asian Paint as well as for Pidilite, I think the growth model is I think remaining quite steady. So in my viewpoint, I think if the stock price corrects and if the valuation becomes I think reasonably attractive, then in such situation, I think they would become a buy opportunity in the portfolio. As I said, I think it's a steady performer. Nothing great that one can expect. I think on a number side, but I think at least 15% plus kind of a growth definitely is given if the steady condition remains as far as I think the margins are concerned.
Okay, all right. Thanks so much, Devin, for stopping by and discussing a whole host of stocks. Wishing you a good day ahead. Well, the cement space, that's been in focus. UltraTech Cement came out with its set of numbers over the weekend. It appeared pretty much in line. The problem was that pricing seems to be under a bit of pressure, and the management sounded rather cautious on that space. Rakesh Arora, founder at GoIndiaStocks.com, joins us. Hi, Rakesh. Good morning. What's your view on, on the cement space? First, UltraTech Cement's numbers were in line, but the pricing pressure that we saw, or lack of pricing growth, is something that disappointed the street. What's your sense?
So, Nigel, normally Q3 is not a great quarter in terms of pricing, and pricing normally moves higher only in Q4 because Q3 you have so many festivals and the labor is away from construction, so all those things really plays out. I'm not really worried too much about pricing because prices are already too high. It is just that the cost is also very high and is likely to come down over the next few quarters. To give an example, coal costs are trending almost $100 per ton higher than where they should be normally. And that translates into 800 rupees per ton extra margin for cement companies. So if UltraTech did 900 rupees per ton in Q3, I think the normalized margin in the quarter was around 1700. So it is just a matter of time that coal prices, go back to normal averages, and cement companies make a huge amount of margin. I don't think cement prices will come off from the levels they are, and in fact they'll go up a little bit more in Q4.
Okay, but Rakesh, the street was building in some price increases. Now they're doubtful on that front in their estimates for FY24 as well. Do you think the street is too cautious that actually some price increases will come about? And then things will be okay. Your sense?
So, Nigel, there are 2-3 things which are happening in the sector. One, obviously, as I said, Q4 there will be price increases because it's a busy season, and demand is normally 20% higher than average. So there is a capacity constraint which comes in seasonally, and you see better pricing. But if UltraTech is growing its volume at 12%, that gives you a lot of indication about how the market is behaving. There was a little bit of aggressive push from UltraTech on volume, and volume and prices never go together. So if volume is at 12%, there's no chance prices could have gone up. And the logical reason is that, Ambuja and ACC is going through a phase of consolidation under a new owner, and they are changing things quite a bit. And UltraTech is trying to gain market share, and that is the only explanation for this. So I'm not too worried, this is a small time, change. But if I look from a 1-year perspective, costs are going to come down, cement prices will go up a little bit in Q4, and margins will expand significantly.
Rakesh, hi, good morning. So, but what about growth? You think growth will be solid? I mean, I'm just trying to understand. Cement, of course, I mean, if you just look at the sector, that's fine, but it's always relative, right? Opportunities and opportunity cost. Is it a sector you would really want to bet on, given growth prospects, etc., or is it just a more tactical trading kind of idea? Go on.
Prashant, so 2024 is general elections, And if history is any proof, cement demand actually jumps up quite materially in pre-election year. So I'm expecting that kind of a solid demand growth. It is just that UltraTech was trying to take advantage of the lull which Ambuja and ACC is going through right now and push more volume. So they sacrificed prices a little bit. But see, prices haven't gone down. They haven't gone up as what people expected. But as I was saying, that a big push will come when costs actually collapse in second half of 2023 calendar year, and that is where margin expansion will come. So we don't really need cement prices to go up too much. They're already high. We just want costs to come down, and coal prices will come down in second half of 23. That is what it looks to me.
So it does seem like, things are favorable for the industry, right? On one hand, as you're saying, costs will come down through the course of the year. On the other hand, there is now not just government capex, but private capex that's also picking up, which means more cement, more infrastructure, etc. Given that, who do you think the biggest beneficiaries could be from a stock perspective?
So, Sonia, you rightly pointed out, that things are looking favorable. And in that scenario, while everyone benefits, but it is the large players who are gaining market share, who are expanding aggressively. And that is the place to stay with for all investors. Don't look for, small, cheap cement companies. They will give you a pop here and there, but they are not really going to be wealth creators.
But what about the other couple of names? The new promoter has taken over, ACC and Ambuja Cements. They had valuation comfort at one point of time, particularly ACC. Would you still go with UltraTech ahead of both these two?
So in a very short term, UltraTech is going to benefit because, Ambuja and ACC under the new management is going through a lot of initiatives for cost cutting, etc., and which is leading to slightly lower sales volume as compared to UltraTech. So if somebody is looking for a 6-month view, UltraTech is better placed. But from a 2-year perspective, I think Ambuja will do much better. And also remember that Adani holds majority in Ambuja, not in ACC. So Ambuja is better placed than ACC.
All right. Thanks a lot for joining in. Rakesh, we're heading into the market opening, but appreciate your thoughts. The pre-opening rates have settled flat with a bit of a negative bias, nothing alarming, just, hovering around that 18,100 mark. But let's get some quick calls at 9:10 this morning. Sudarshan, what are you looking at?
Well, the Nifty is an avoid. Infosys is a buy with a stop under 1540.
Okay, and Mitesh, how about you?
Yeah, I'll go with a buy on L&T, Infotech and Mindtree, that's LTIM, with a stop at 44.55 for targets of 46.10.
Okay, both you folks picking up IT stocks. Interesting. That's been an uptrending space. But the other space that's looking good this morning is autos, and Maruti is your top Nifty gainer. A lot of brokerages have raised their target prices on Maruti post a strong set of numbers that the company reported yesterday. UBS has a buy. They've raised their target price to 12,600. Citi has raised the target price to 13,100. They've raised their earnings estimates as well by about 9 to 16%. Then you have Goldman Sachs that has an 11,000 target price, and across the board you will see anywhere between 11 to about 13,000 is the target price. Now Morgan Stanley expects the market share to rise to 43% in FY24 versus 41% in FY23. In case you missed out on the earnings yesterday, very strong set of numbers. EBITDA margins at 9.7% is the highest we've seen in the last 17 quarters for Maruti, and the management commentary was also optimistic. They said that Q4 volume should be higher than Q3, and they do not expect any major headwinds, commodity headwinds or yen-related headwinds in Q4, and the order book is very strong at about 363,000 units, which provides a 2.5-month visibility. So that's Maruti for you, the biggest Nifty gainer. But let's go across to Ekta now to find out more about Sun Pharma. Ekta.
Thanks for that. Well, yes, it will be reacting to Taro's numbers, which came out. It is their US arm. Now, the positive about Taro is that there is a Q-on-Q recovery. The net sales came in at $139 million versus $130 million in the previous quarter. Operating income, $1.3 million. Margins, 1%. This is versus a loss in the previous quarter. Similarly, net income, $7.3 million versus a loss of $2.8 million. But year on year, the numbers remain weak. To give you a comparison, margins 1% versus 27%, and a net income which is down around 70% on a year-on-year basis. The company has said they continue to experience price erosion in the US markets, but the cash on books is high, $1.2 billion. Plus, the stock was up around 2% in US trade, and the contribution to Sun's EBITDA has reduced over the last couple of quarters. Hence, Sun could probably be in the green today.
Okay, thanks a lot for that. Well, United Spirits is the other one, not so high-spirited it seems. Surbi is here to give us the latest on that. Surbi, over to you.
United Spirits will be in focus today, and that is because they have declared their Q3 numbers last evening and they don't look so good. Even when you adjust for the slump sale of the popular brand, the revenue growth is just 10% on a year-on-year basis at 2781 crores, and that is also largely led by increase in prices on a year-on-year basis. Gross margins are under pressure. The gross margins are impacted by the high input cost inflation and is down 400 basis points. This is trickled down to EBITDA as well, which is down 12.4%, and margins are down 340 basis points. The company has spent 150 crores on a supply chain agility program, which affects their profitability as well. If you exclude that, the PBT is down 3% at 303 crores. Now, usually Q3 is really good for United Spirits because of the festive season, but both the segments, premium and popular, have just seen a volume growth of 3% odd. The realizations of the premium segment is up 8%, and that has led to majority of the revenue growth. The popular segment realizations is down 1% on a year-on-year basis. The company has sold stake in its wholly owned subsidiary, Sovereign Distilleries, for 32 crores and also made an additional investment in Now Spirits and Distilleries for 15 crores. The management has commented that they expect the inflationary headwinds to continue for the shorter term, so the stock could see some pressure.
Okay, thanks a lot for that. Well, here's the budget quiz. When did Nirmala Sitharaman present her first budget? And those are the options for you on your screen. All you got to do is send us your answers on Twitter, post your answers as a comment on the question tweet on CNBC-TV18 News. Use the hashtag budget with CNBC-TV18. Hurry and send us your answers. We will announce the winner at 3 p.m. today. But let's get all set for the market opening. There is the first tick on the index, down a tad bit actually, down about 0.2% on the Nifty, down 40 points. The Sensex as well is down about 130 odd points. So give and take everything, it's just pivoting around that 18,000 mark on the index. The Adani Group is under pressure. Adani Enterprise, Adani Ports, we were mentioning this earlier. So those are the big losers this morning. L&T is down 0.7%. ONGC, HDFC, Sun Pharma and Indocent are a couple of other big losers this morning. There's a little bit of profit taking that you're seeing in IT names as well. Infosys, HCL Tech are both down 0.5%. Remember, HCL Tech is the biggest monthly gainer. It's up 9%, so maybe some profit taking over there. Kotak Axis also seeing a little bit of profit taking this morning. SBI as well, down a tad bit in the red. It's nothing alarming really. It's just some churn sectorally that you're seeing. Autos are on top. Tata Motors comes out with numbers in the evening, was the biggest gainer yesterday, biggest mover today. Maruti Suzuki brokerages have raised their target price. TVS Motor reacting well to its numbers. Hero MotoCorp as well charging ahead. So the entire pack is looking pretty good. M&M not too far behind either. Then you have a couple of these metal names. Tata Steel in the green, up 0.3%. HUL is just about trending above the green line. And then, something like a Hindalco and Grasim also trending in the green. So the market is a bit subdued as per what the SGX was suggesting. A lot of result reactions in the broader markets, the likes of Pidilite under a bit of pressure right now. But all in all, you'd have to say 50 points lower. So not moving the needle too much, but a subdued start.
Well, that's right, Sonia. The couple of gainers, though, as Sonia told us, TVS Motors numbers are good. Fifth straight quarter of 10% margins. The stock is up close to 2.5% despite higher valuations. Soam Distilleries, well, they delivered a profit versus a loss, so that's pretty good news as well. And Bliss GVS, out there you had the revenues that were down, but the EBITDA came in higher as well as the margins expanded. So that as well, smaller stock from the broader markets, that as well has opened up well in the green. Lakshmi Organic, well, the numbers look pretty okay, but that stock has come in for profit taking. It's down close to around 4% as we speak. So just pull up the intraday chart out there. That one's under some pressure. You have Pidilite, that's down. Quarter 3 was below estimates. Volume growth slower. Margins under pressure. United Spirits as well, the revenue growth was healthy, but the margins under pressure. So that stock is under pressure. Indus Bank, well, they reported a loss for the first time. Doubtful provision of around 2,300 crores odd. So that as well has pulling back closer around 3% odd. It's pulled back actually from the low point of the day. Macrotech, the numbers looked okay, but now they're revising their debt reduction guidance to 7,000. Earlier they were talking about a number of closer around 6,000 crores odd. So despite good numbers, the street has taken note of that. That stock is well opened up in the red. And Tatva Chintan as well as Saskin, both those two stocks reacting to the numbers opened up in the red, both of them seeing a bit of a downtick. 3.5% on Tatva Chintan, and also Pull-Up Saskin, that as well had a negative start. Prashant.
Right, Nigel, thanks for that. Well, it's neither here nor there. It's a flattish kind of start is what it is. And things are looking a little weak at this point in time. The indexes, will it pick up momentum in either direction? I think that remains the question. And I think a lot of people would be waiting for that, for the market to tell us what it wants to do, really. Market breadth, by the way, it's early, but it's negative. So, some 1,000 stocks are lower and about 700 stocks are higher at this point in time. Let me just see what else is moving. United Spirits is down a full 5%. We highlighted that earlier and sort of emphasized that right before market opening. 777 on United Spirits right now. Pidilite is sort of cracking a bit more. It's down a full 2.5%. Zomato comes up with a 2% loss. Stocks at about 51 or so. Container Corporation is down 1.25% as we start. There is Mazgaon Dock. Only highlighting things with volumes. Mazgaon Dock is down 1.5% to begin the day. Tata Elxsi is down 1.33% right now. Ambuja Cement is down about 1.5%. And there is Dixon, which starts about 1.25% lower. These are well-traded, large, liquid names which are coming up with some cuts. Market breadth has now decisively moved into the negative 2:1 in favor of declines as we begin the day. I think we highlighted Nazara, which has got 4% gains. Sharda Cropchem is another one, which is coming up with a 6% gain. So some gainers as well, 518 on Sharda Cropchem. CG Power is up 2.5%, of course, reacting to results. And there is Car Trade, long forgotten, down and out, but the stock's up about 5%, back at almost the 500 rupee levels at this point in time. So that's basically a little bit from the broader market. We're down 60 now, 18,058 is where we find ourselves at. More in terms of stock reactions in a bit. Mihir Vora is our market master of the day, Director and Chief Investment Officer at Max Life Insurance. Mihir, good to have you with us here. Thank you very much. The last year we stood out in a good way. This year we're standing out not so good way. But it's not very much, right? I mean, global markets are up or flat. We are down a little bit. Do you think this phase has got more to run? And what are the big factors which will influence it? I mean, the budget, for example, is just a few days away. I don't know if you have any specific thoughts on that and what the market may do in reaction to that. But to your mind, what will be the dominating drivers?
Good morning, Prashant. Always a pleasure. So, if I were to just summarize in a few lines the current market and global situation, it's compared to, say, 3 or 4 months ago. Now the concerns about inflation, peak inflation, are past us. The concerns of very bad recession are also probably past us. So the peak fears of inflation and growth are probably past us. And that's because of the incremental data that we are seeing over the last few months. It's that the Europe slowdown is not as bad as feared. People are really expecting Europe to collapse because of the energy crisis and gas prices, but it's held up quite well. And in fact, they've adjusted the energy mix quite well. And the mild winter also helped. The US slowdown is probably a bit worse than expected, but again, people are now talking about a mild recession rather than a very sharp recession. And the third thing is that the China opening up has been much faster than expected. So the worst of the growth fears are also probably past us as far as the global economy is concerned. So to that extent, the peak hawkishness of central bankers is also probably past us. Mostly we are talking about 1 or 2 more rate hikes and then done as far as the global central banks are concerned. So I think the worst of the fears on interest rates, inflation and slowdown are gradually petering away. And to that extent, when we were taking the call last year, is that India will do much better than the global economy because of the global concerns. That argument is a bit more diluted, and that's reflecting in the market performance. So while India may continue to do well in absolute terms, we are seeing catch up by the rest of the world, especially the US tech space, Chinese market, etc., because they were really beaten up last year.
Well, by the way, I just want to mention that the market cuts are deepening. So the Nifty is now down almost 75 points. It's interesting to see the list of losers because banks are now seeing some serious underperformance. The bank Nifty itself is down 200 points, and you have all the top losers are banks: Axis, SBI, HDFC Bank, a couple of others in the smaller names as well. Amir, I wanted your thoughts because, are we seeing a churn now out of banks and into IT just purely to catch the valuation upside?
Absolutely. So, as I said, the US tech space has really done very well in the last couple of months, of course, from very sharp bottoms that we saw last year. And Indian IT is kind of mirroring that expectation or that movement because we've not seen really bad earning cuts as feared. Though my expectation is that if the domestic economy continues to do well, IT is still overvalued relative to, say, 2019-20. It's been one of the most re-rated sectors, so to say. But if the domestic economy doesn't do as well, then IT can outperform. That's the call that we have.
Hi, Mir. Talking about the domestic economy, the sector that's come in for a hard knock has been cement, in the last few days particularly. That was, a favorite. I mean, people were counting on 2023-24 to be a good year, given that we have elections that are coming up, construction work, housing sector demand as well. As a house, what's your view on the space?
So cement, we are neutral on the sector. The sector had done well because there was expectations that with a new player coming in, there'll be massive improvements in cost, and we did see some announcement to the extent of curtailing cost of transportation, etc. I think that theme will continue. The reason why the cement sector underperformed last year was basically because of high energy costs, and those energy costs are coming down. So even if the transportation, etc., efficiencies by the new player take time to come up, there will be improvement in the other costs because of the energy, energy prices going down. So to that extent, if there is pricing discipline, which I think it is, the cement sector may actually see earnings upgrades even without much action on the other side. So to that extent, we are not as negative on cement as we were last year.
Okay, that's interesting. So just to follow up there, you're saying cement sector may see an upside. What about the ancillary spaces? So there's real estate, there's infrastructure, there's, home improvement. This entire theme picks up together generally. Do you like this space?
No, because I think in all those segments, while they are good growth segments, valuations are not very comfortable, and most of them are mid and small cap stocks. So anyway, we don't have too much exposure in our large cap fund, which are typically our flagship funds. But even now, I'm not really comfortable in the building materials valuations, as I said. So to the extent we have very minuscule exposure there.
Mihir, the entire consumer space, right, consumption basket, is this, you think, just like a bit of a valuation reset which is happening, or you think, looking at results, and now we have numbers from Pidilite, last week we had so many numbers, right, from a wide array of sectors within the consumer space, is there a worry that maybe there is a bit of an underlying slowdown which will continue to fester for the bulk of this year? What's your sense?
Sure. So the consumption has been a mixed bag. In the first half, we saw rural doing okay, and the second half, the rural slowdown was really apparent. And urban was relatively picking up, especially the discretionary space, maybe partly because of pent-up, the busy season and revenge travel, revenge spending, etc. But in the last few weeks, again, we are getting signals that urban consumption probably might be faltering a little bit. But on the other hand, there are some incipient signals that the rural space might be picking up a little bit. So I think rural inflation, which was one of the big causes of rural slowdown last year, is hopefully past us. The peak rural inflation is past us, and we should see rural recovery slow but steady in the last in the next few months. My guess is that the government focus on the budget will also be more on the rural side. So rural capex spending, etc., may still continue. And because of the little bit of loss of traction on the urban side, you may see some initiatives in the budget, something like urban Manrega, maybe increasing the income tax slab rates for the salaried urban class. So to that extent, maybe some focus to help the lower end consumption, which is not seeing that much of a traction even last year and even as we speak. So I think high ticket consumption was doing better. Low ticket consumption, both on the rural and urban side, seems to be picking up a bit slowly. So you might see some initiatives towards that.
Okay, all right. Well, we'll leave it at that. Mihir, thanks a lot for joining in and giving us your view. The market is under a bit of pressure now, so 78 points lower. Thanks for that. But a couple of stocks deserve mention. TVS Motor is up 2.5% right now, so that stock is doing quite well actually, post its numbers, as well as the commentary that came in from the management where they have raised their guidance. So 2.5% higher on TVS Motor. Sona BLW, and we'll talk about that in greater detail as well. Good numbers there too, up almost about 2%. Route Mobile had a strong showing yesterday, and that's adding on some more weight. So 4% higher on Route Mobile. And UCO Bank, after the management commentary, UCO Bank is up almost about 3%. So there are stocks which are sort of seeing outsized gains despite the market being very, very quiet. So names like Shoppers Stop, Relaxo Footwear, Chalet Hotels, a couple of other names which are outperforming. We'll also talk a little more in detail about SBI Card in a bit. So let's just get SBI Card, the stock, up for you on your screen. This time the net interest margins were at an all-time low. So I think that is something that's really dragging the stock this morning. So we're going to talk in greater detail about that. By the way, a couple of other result reactions include the likes of United Spirits. So that one as well is down almost about 4.5%. So there are result reactions in the market, but overall you'd have to say it is a quiet start.
It's a quiet start, absolutely. Maybe just a few more names before we bring in our next management. Nykaa is a name which you may want to look at. It's down 1.5%. Stock was up 7% yesterday on very strong it was up 7%, has underperformed, lost about 70% from the highs. Yes Bank is down about 1.25%. I pointed out Ambuja Cements. ACC is another one which is down a little bit. And you've got a bunch of these other names which are, there is more down than up at this point in time if you look at the broader screen. Sonia.
Okay, we were just mentioning how SBI Card is under pressure post the disappointing set of numbers. The net interest margins came in at an all-time low for the bank, and over the last few quarters the revolver rate for SBI Card has also come down to around 24% from the earlier 45%. Ram Mohan Rao Amara, who's the MD and CEO of SBI Card, joins us now. Mr. Amara, the growth has definitely slowed down. The business momentum has been a bit weak over the last couple of quarters. Just wanted to understand from you in terms of new accounts, there's still a growth that you're seeing, but what is the kind of trajectory? In this quarter gone by, your new accounts were about 16.5 lakhs and the new cards were at about 1.59 crores. Can you give us some numbers on what the next few quarters could look like?
Good morning, Sonia. As you rightly said, the Q3 new account acquisition has been around 1.6 million, which is a 60% growth as compared to last year, corresponding period. So we are growth focused. For us, all the channels have been delivering, both banker as well as open market. Digital channel has also started contributing in a significant way. But the results of it's more like an investing for future, in the sense a typical new customer takes time to start using the card in a big way. Only over a period of time you start seeing them spending for big ticket transactions as well as on the discretionary goods. So the results will be coming. I mean, the positive impact of this investing in growth will be visible in the next few quarters to come. As far as acquisition is concerned, we have stated a stance of maintaining a net addition of minimum 300,000 per month. Last few months we have been able to maintain that, and this will be our endeavor, where we would like to maintain a kind of sustainable growth, at least a kind of 1 million net addition per quarter we want to ensure by managing both the card issuance as well as the attrition.
So that is 300,000 per month is for new accounts, is it?
Yes, that's a net addition.
Okay. Net addition. Okay, got that. We've been having this conversation ad nauseum about how the spends per card is slowing down a bit. I mean, this time as well, your growth in spends per card is barely, less than 5%, low single digit. Why is that? And what do you see as, is there a sort of changing trend that you're noticing amongst customers? And what do you see as the growth in spends per card for the rest of the fiscal?
Spends per card, the metric which you said and the kind of figures what you alluded to, I think comprises even the corporate card spends as well. If we knock it out as report, the corporate card spends and only focus on the retail spends per card, we have recorded a 8% year-on-year growth, despite the base growing by 21% during the last 12 months. So that way, through improved engagement efforts, by making right offers to the customers, we are actually able to maintain the momentum in the and increase in the per card spends. Looking at the retail spends, our retail spends have actually increased by 29%, backed by the kind of festival spends and of course the revival in the travel segment in a big way. And in general, there is an improvement in the discretionary spends. So all these things have culminated in a 29% year-on-year growth in the retail spends. While of course we have a corporate card spends, they contributed around 10%.
Okay, all right. Hi, Mr. Amara. You know, there are two problems with the numbers. One is the declining revolver contribution, which has come down to around 24%. And the second factor is the cost of funds are likely to go up even from year on after increasing in the past quarter. So give us some bit of a guidance on both those two. How is the mix likely to change? Revolver has come down. Has it bottomed out? Will it increase from year on? Point number one. And the second factor is the cost of fund goes up by how many basis points in quarter four?
Yeah, revolver is at 24%, which is at the same level as Q2. We have seen our internal analysis does indicate like after the pandemic and after cleaning the portfolio from the chronic revolvers, the share of the chronic revolvers, that means who typically revolve more than 6 times in a year, I think that share is slightly declining. But having said that, actually the revolve balance absolute amount, if you look at, actually it is growing. The point is like it is not in tune with the overall linear growth, so that's the reason the revolver share is slightly low. But otherwise, in terms of new additions, etc., the revolve balances are increasing. But having said that, in as much as the credit costs are well within our internal range, acceptable range, we are experimenting with a new segment. We are increasingly getting younger generation as customers. We are increasingly attracting self-employed who have better propensity to revolve. So we are hopeful, while the pace hasn't been at the desired level, we are still hopeful that the revolve will increase over a period of time. Coming to the cost of funds, we guided in the past as well, given that actually majority of the funding happens through short term, and given the fact that actually asset loans are given on a fixed rate basis, whenever there is increase in the interest rates, you will witness a kind of faster increase in the cost of funds as compared to yield on the loans, putting a pressure on the NIM. So in the past, we guided that the cost of funds will increase, but we have absorbed most of these repricing, etc. So next quarter, we will be seeing maximum like a 30 to 40 basis point further increase in the cost of funds. But we are confident of absorbing it actually through two measures. One is by constantly focusing on the share of EMI loans, which has steadily been increased quarter on quarter, and also transmitting the rate in the loan disbursals, which will help us in offsetting the cost of funds.
Okay, valid points then. Revolver is not giving so much traction, but your focus is on EMI and you're looking to pass through the higher cost of funds as well, which could go up by around 30 to 40 basis points. What does it mean for the yield? Now, for the past quarter, yield is at around 16.4%, which was maintained on a sequential basis, but your NIMs had come down to around 11.6%. So will NIMs increase from this 11.6% odd? Give us a guidance on that number. And credit cost as well, you said, things are improving out there. So what's the guidance? Wanted numbers on both these two.
As I said, the NIM will fairly stabilize, maybe 10 basis points here and there, that movement can be there. But we are fairly confident that actually NIM will stabilize in the next quarter at the current level.
Okay. Actually, I had a follow-up here as well. I guess the reason why Nigel is asking you is because, in FY21, your net interest margins were at 15.8%. So just trying to understand, when will the NIMs bottom out? And is 15% plus NIMs doable, say, in the next, 1 to 2 years?
I alluded to a kind of balance sheet structure where the loans carry a fixed rate of interest, while the funding is majorly through the short term. In a declining interest rate regime or a benign interest rate regime, it helped us actually improving the NIM. But at the same time, in an increasing rate of scenario, this has an adverse impact on the NIM. We are taking different measures. We are operating at a different level. We are looking at cost efficiencies, rationalization wherever is possible. We are investing in the future. So this will actually help us in terms of absorbing whatever the little dips are there in the NIM and some fee lines, and help us maintain a healthy proportion between the interest income and the non-interest income at 50% to 50%. So credit costs, we alluded to credit costs at 5.6%, which is a decline of 60 basis points as compared to last quarter. Ignoring the quarter-to-quarter variances, we are fairly confident of keeping it below 6% over a period of time.
So
Mr. Rao, on earnings then, let's just kind of put all of this together. What kind of earnings growth should we expect? I mean, the street is expecting between 25 and 30% earnings growth for the next couple of years. Is that reasonable?
I think, as I said, the rapid growth what you see in acquisition will not immediately translate. There will always be a lag effect. And of course, we have a play of interest rates now. So it will be at the current level for a couple of quarters because we are absorbing a lot of changes that are happening in the ecosystem, be it the interest rates, be the kind of regulatory changes that are happening, etc. For a couple of quarters, the current rate of growth only we will be able to maintain.
Okay, just one question. What would the impact be of this MDR discount removal from the RBI? How big is it for banks and what would the impact be for you?
If I'm correct, I think it's only a discussion paper released by RBI as of now. So we have shared our feedback along with other industry players, and the RBI is yet to take a call on MDR. So
but if it does come through, then no. But if it does come through, then what would the impact be?
I mean, in the past, several times this aspect was visited, where the industry has given the feedback and pleaded a case why it should be treated differently, and why it is unique as compared to debit card in terms of offering so many benefits to the customer and then footing the credit cost. This aspect was considered, and that's the reason it was not touched. We don't know, if at all, if it is revisited, to what extent the MDR will be impacted. If it is a small kind of impact, then obviously it can be taken in our stride. If it is a larger one, obviously we need to look at what costs we can rationalize.
Okay, all right. Very quickly, sir, your cost-to-income ratio, that's moved up to around 62%. Does it normalize at lower levels from here on?
Normally, Q3, which is marked by the festive period where the cashback offers are also made on a larger scale, normally we see, this is the seasonality, this is the trend what we see, at an elevated cost income will be there for Q3, and it gets normalized in Q4. So we are confident of keeping the cost to income below 60% in Q4.
Okay. All right. We'll leave it there. Thank you very much, Mr. Rao. Appreciate you joining in and good luck. Maybe a better quarter the next few. But rates are rising. And as the SBI Cards management said, cost of funds will go up. NIMs maybe here, 10 basis points here or there. That's key. 90 points lower, by the way, than markets at the day's low. The Nifty will come up, the Nifty intraday will come up on your screens. And, overall market breadth is also looking worse off. I mean, 1250 stocks are lower, 700 stocks are higher. We'll come back with Girish Kausgi of PNB Housing Finance to talk about the third quarter earnings. And later, we'll have the management of Sona BLW to discuss their acquisition of 54% stake in Serbian company Novelic. Stay tuned.